Hey everyone, this is Madan Ravindran. In this video, I'll be explaining the strategy called cash secured put. This is one of the very beginner friendly strategy, especially for an investor who's looking to buy stocks at a discount price, or for the traders who are thinking of getting a steady premium income. So this video is for you. So we'll in this video we'll break down the strategy with a real life example. Step with a step by step explanation, and I'll show you how to handle different scenarios. So what is cash secured put? So let's say you're telling the market that I am happy to buy this stock at the specific price. If it drops there, and in return I'll get paid some money upfront for making that promise. So in this case, if the stock doesn't drop to that price that you're expecting, you can still keep the money as your profit. So in case if the price drops, you will buy the stock, but effectively at a discount because of the money that you have already received. So why do we need to do all this? So this is to earn premium income. So for example, when you sell a cash secured put, the buyer of the option will pays you a premium upfront. So this premium is your income for agreeing to potentially buy the stock at the strike price in case if it is assigned. So with this strategy, you can make a constant income as long as the stock doesn't go to the price that you're expecting to buy, right? So and the second thing is like potentially buying stocks at a discount. So it is because you are buying the stock at your expected price instead of the market price. So because of this, you are kind of buying at a discounted price, right? And the last one is lower risk compared to naked puts. So compare when you compare it with the naked put selling, so cash secured put is considerably safer option strategy. That is because you already have the cash set aside to buy the stock in case if it is assigned. But the most important thing here to be remembered is you need to have enough cash in your account to buy the shares if the options get exercised. So let's see this with a real life example of a cash secured put. So a cash secured put can be either be done in the futures market or in the cash market. So first, we must decide whether our goal is to enter the stock at a specific price in the future market or to buy and hold the stock directly in the cash market. So we have to decide either be it for a long-term investment or for the swing trading. So we have to decide whether we are picking as a futures or in the cash market. So I've already explained the risks and rewards of trading through futures. In case if you are not familiar with how future trading works, please watch the video that I've given in the description box. So based on that, you can decide whether you want to buy a stock in the cash market or in the futures market. So let's say today is December 25, 2024. So I am thinking of going along in Hindustan Unilever in case if the stock goes to 2200. So currently it is trading at 2330 rupees. See, generally I prefer to choose high quality, fundamentally strong stocks, and HUL fits that criteria as a large cap stock with a very good solid fundamentals. So and also like the stock has already corrected by more than 20% from its recent high. So and also so since I believe 2200 will be a very strong support level, and so I'm thinking of doing a cash secured put at 2200 levels. And in case if the stock goes to 2200, I would be willing to buy the stock at this price. So to execute the cash secured put strategy, I could sell a 2200 put option, receiving a premium in return. So in case if HUL falls 2200 or below, I'd be assigned the stock, and I am required to purchase a number of lot size which is 300 into 2200 per share, which means I must have enough funds available in my account to buy the stock in case if the option is exercised. So what are the possible outcomes here? So let's see the scenario one. So let's say the stock stays above 2200 at expiry. So if the stock stays above 2200 by expiration, so the put option will expire worthless, and you're keeping the 11.5 rupees premium as your profit. So which means 11.5 rupees the premium that you have collected into the number of shares of lot size, which is 300. So we are receiving the premium as 3415 profit. So you made the money without even buying the stock, and you can do this almost every month and make regular income as long as HUL doesn't come to the price that you're expecting. So let's see how much fund is needed to sell this naked out of the money option for HUL at 2200 strike price. So to see this, let's use the Opstra website to understand how much fund is needed and how much will be our maximum profit and what is our break even. So we can see all this in the Opstra website. This is the Opstra website homepage. You click on the option strategy builder, and you select Hindustan Unilever as your stock and select the next month series. which is January 2025, and select 2200 PE as your strike price and click on sell. So here you can see how much fund is needed to sell the put option. So you can see you need roughly around 85,000 is needed, and you are collecting some 3,500 as your premium. So if you see 3,500 premium from 85,000, your return of investment will be somewhere around 4% every month, which is a very decent return, I would say. So what is scenario 2? So let's say stock drops below 2200. So in case if the stock drops below 2200, you will be assigned and you will have to buy 300 rupees shares at 2200 each. But wait, since you already received 11 rupees 50 pice per share as your premium, so your effective price here will be 2189.5 per share, which is because 2200 minus the premium that you collected. So that is a price that you're gonna pay when the stock is assigned to you. So you are still getting a discount compared to the original price of 2200. So what will be your risk and reward here? So the maximum profit that you will be getting over here is the premium that you received, which is 11 rupees 50 paise, into the number of stocks of lot, which is 300. So which means 3450 is a premium that you are earning. So that will be your maximum profit here. And the maximum risk would be if the stock price drops below 2200, you will be owning the shares at 2189.5, but you are still cushioned by the premium. So how to adjust a cash secured put? So sometimes the stock might move against you and you don't want to take a delivery of the stock. So there are few ways to adjust this. So first thing is you can roll out the put option. So buy back the current put and sell another one with a later expiration or lower strike price. So for example, if your original price was 2200, you could roll a 2100 strike for the next month's expiry, so which will reduce your potential purchase price and also possibly collecting more potential and more premium. And this is one way of adjusting. The second way of adjusting is you can close the position. You can simply buy back the put at a loss and exit the trade to stop further downside. So this is basically you're booking a loss. You are just buying back and you are not buying a stock. This will be a loss. Suppose if HUL goes to 2200 at the end of the month, you are booking 100 rupees loss over here. So say for example you sold the 2200 put option for 11 rupees 50 paise, but now the premium has risen to 50 rupees due to the stock falling significantly. You can buy back the put at 50 rupees, which will make your net loss as 38.5 per share. So which will be 50 minus 11.5 rupees the premium that you had collected. Or the last way is by taking delivery. So if you are okay with owning the stock, let the option expire and you can own 300 shares at the strike price. So for example, if HUL is now trading at 2000 at expiry, your loss on paper will be 189.5 share into which is basically 2189.5 minus 2000, which will be a 189.5 per share. So what are the pros and cons of cash secured put? So the pros, the first one is like you can generate a consistent premium income. So as per this example, selling a 2200 strike price put at 11.5, which means you are collecting 3450 as your premium upfront. So you can generate a consistent income as long as it doesn't go at your expected price. And also like potential to buy stocks at the discount. As I said, if you sold a 2200 put and received 11.5 rupees in premium, your effective purchase price will become 2189.5, and lower risk than naked puts, because in case if the HUL is dropping below 2200, you are preparing to take a delivery rather than booking profits, right? So there will be a less risk compared to the naked puts. So what are the disadvantages? So for this, the main disadvantages, you need a huge capital for this, because if you see the cash for 300 shares, so as per this example HUL, so 2200 is the cost price of the HUL into number of shares, which is 300 for the lot, which will be roughly around 6.5 lakhs is needed in your account. So at least in case if you are going through the futures instead of the cash market, still you will be needing around 2 lakhs to enter into the futures. So and another thing is the risks of assignment. If the stock price drops significantly, assume if the stock price falls far below the strike price, and you will be obligated to buy shares at the agreed strike price. So even if the market price is much lower, still you had to buy it at the agreed strike price. So in case, for example, if HUL drops to rupees 2000, so you are still had to buy at 2200, so which makes a paper loss of 200 rupees despite the premium adjustment, right? So these are the cons of cash secured put. So in case if you are planning to do cash secured put, just remember that always choose a high quality stocks that you're comfortable owning in case if it has been assigned, and don't over leverage your cash, and always use liquid options with a very good volume, and also you have to monitor your positions regularly. So these are the key ways to success with the cash secured puts, and the patience and discipline is also very important when you do option trading. So I would say cash secured puts are very profitable for generating income and potentially buying at stocks at a discount price. So if you enjoy this video, please do not forget to hit the like button. Please subscribe to our channel as well for more option trading strategies, and leave a comment below if you have any questions or you want to share your experience with cash secured puts. That's it from me. Thanks.